battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. This is episode 191. I'm Nick Stenger. We are Stenger Family Office. For the past 44 years now, it's been our family's mission to deliver you both clarity and confidence to help secure your financial future. Thanks for being on. I am on the road here in Houston, visiting with many of our clients down south, and the weather's about the same as Chicago, so almost no change, having a little heat wave back home. But here we are, episode 191. It's our mid-year outlook. If you can believe it, it's already to the halfway point of 2025. Not sure where the year's going. It's just flying by. And the S&P today is basically back to its record all-time high. It's within a few points. And I think that's just absolutely astounding when you look at the narrative from where we started at the beginning of the year, a mostly bullish narrative from a lot of places on Wall Street, immediately changing to bearish when the tariffs started coming out. And then they all these places on Wall Street revised their estimates for the S&P lower. And now the S&P is back to record all-time highs. It's almost like clockwork. The second that all the Wall Street doom and gloom strategists revised lower, that was the time to buy. That was the time where the S&P was trading at a tremendous value. And if you watch this show on a regular basis and you subscribe on YouTube, which if you aren't already, we would ask you, please subscribe so you can get the show out to more and more people. It helps us get more clarity and confidence to others out there who need it. Because if you had followed those doom and gloom strategists, if you weren't getting the clarity and confidence and you were just listening to the narrative and listening to CNBC or Fox Business or whichever show you were watching, you might have panicked and sold stocks at the most opportune time to buy them. When the S&P was 4,950 or 5,000 points, we said, hey, it's not the most, it's not a generational buying opportunity. It's not the best buying opportunity on record. It's certainly not the COVID buying opportunity or the 08 and 09 buying opportunity, but we said it would be a tremendous buying opportunity for investors. And so that's exactly what you did. You just stayed on your plan. Maybe you allocated a little bit more to equities. And every single time the market's corrected, it has been a buying opportunity. Don't ever forget that. Whenever you see the market sell off 5% or sell off 10%, certainly 15 or 20%, that is a buying opportunity. In fact, there's never been a time in 200 years of market history that's not been a buying signal. Now, you may not get the absolute bottom. You may not pick up the S&P at 4,950 exactly, but if you picked it up at 5,500, who cares? We've got a long ways to go. There's still a lot of baseball left to play. Technology is just at the cutting edge of I think, really some incredible things coming down the road this year, next year, into the next 5-10 years. And like I keep telling you on the show, you don't know what the future holds. You don't know how exciting the future is going to be. Human nature is to say, I'll be worried and fearful and scared because I don't know what the future holds. But rather, I think it's the opposite. It's the Ecclesiastes mindset that no. Instead, because we don't know what the future holds, that should make us excited because we just don't know what's coming. And that's very, very good for investors. Now, when we get into the market outlook for the rest of this year, I actually want to share some of my window into where I think we could be going in 2026. Obviously, these are long-range estimates, so we may not hit these spot on. We may not be exactly to the day when the S&P hits my estimates. But I just want to give you the math of the market, because the math of the market is really what drives our investing decisions, not emotion, not reacting to news, not reacting to scare stories or reacting to what comes out on a day-to-day basis with Mr. Market calling out different prices for what the S&P is worth. Rather, it has to be math-driven. And I take you back to this math equation almost every show because I think it's so important to understand when times are bad that the math of the market will remain true. And then when times are overly good and there's exuberance in the market, which I don't think we're anywhere close to exuberance on the entire S&P yet, but also when there's exuberance in the market, you have to remember the math of the market as well so that you're not overpaying for stock. So the basic equation of markets is this: earnings times what are those earnings worth in the future. And if you do that backwards, it's actually the PE ratio, the price to earnings ratio. And the big question is, and we know what the factors are that drive those two numbers, but the big question is, what are companies really going to be worth in the future? And I think that's the incredibly tough thing to understand. Now, when you're diversified across 50 or 60 companies like we are at Stenger Family Office, if you own the S&P 500, now you've got 500. I think the 50 or 60 top companies are going to be better, and they're actually going to be a little bit better suited to handle volatility long term. We can talk about that. But when you have a diversified basket of securities, you may overpay once in a while for a company. You may underpay once in a while. Hopefully, you're underpaying more than you're overpaying, and that's typically what happens. But over the life cycle of the portfolio, you're going to see the math and market even out, where the S&P over time is probably going to be worth anywhere from 20, 21 times forward earnings. Now, why do I say forward earnings? And this is what's really important to understand. Investors a lot of times look backwards. That's the biggest mistake you can make on the good side and the bad side. You could look backwards and look at a stock that trades for 100 PE, but if you look at forward earnings, like NVIDIA now, a great example of this, is actually going to trade at a much more reasonable PE once their earnings continue to come in like they have been. So if their earnings growth has been strong going forward, the stock's PE is going to drop. Their price that you're going to pay is actually going to be pretty reasonable. On the other hand, you could look backwards and you could say, oh, a stock looks like it's really cheap. It's trading for 10 times earnings. But in reality, their earnings are going to drop next year. Expectations are going to fall off a cliff. And then all of a sudden now the stock's going to trade for a 30 PE. And so that's what you want to be very careful of, is not just looking backwards, but really looking forward. And that's what markets trade on, is forward PE. Now, when we look at the S&P 500 trading today at 6,000 points with earnings coming in right around the 280 line, 290, with some estimates for next year looking to be around 300, maybe just over 300. That's going to make the S&P's fair value actually pretty reasonable here. I'm not going to tell you it's tremendously undervalued. It's certainly not undervalued like it was when S&P was 5,000 and you had some of these stocks trading at 10 times forward earnings. It's not that cheap, but it's still not overvalued when you consider next year's profits. You're always going to look out about 6 months to a year and say, what do we think 2026 estimates will come in at? And then let's discount that to today's numbers, and figure out if that's a reasonable price to pay for stocks. Now, we're already looking to 2027 profits as well. And this is where it gets a little more fuzzy because the future is uncertain. And we don't know what profits are going to come in at for 2027. I will tell you, traditionally speaking, companies put out estimates, they put out their forward guidance mostly conservative. You'd be absolutely out of your mind as a CEO to come out and give guidance that's way too high and then just get absolutely beat up in the markets. There's no reward for companies to do that. So companies are incentivized to promise and over deliver on their earnings. And that's why companies have this propensity to beat earnings estimates. It's much more in their favor to beat than to underperform. And so as we look to 2027, all the best pundits on Wall Street, all the people who've actually gotten it right over time, say that S&P profits now for 2027 are trending towards $340. And this is why I keep telling you 340 times 20 basic math puts the S&P at 6,800. I think actually we're going to trade the S&P a little bit richer than that, maybe closer to 20 and a half times earnings, maybe 21. Why? Because I do think the Fed is going to moderate. They're going to have to be forced. They're going to have to cut at some point. And I actually think they need to deliver about 0.5% in cuts. They'd probably do it over 2 cuts, a quarter and a quarter, but they should cut. We talked about that last episode if you want to go watch that and watch my explanation of why I think the Fed should cut. But all that being said, I think the fair value as you look out 18 months on the S&P 500 is pretty darn close to 7,000. And if you're still coming in today, you're thinking, Nick, did I miss the run up? Did I miss my opportunity to buy? I'd say absolutely not. Because from today's level at 6,100 to 7,000 with the dividend, that's almost 16% upside on the S&P. Now, I can't give you a promise on when that's going to happen. I can't pull out the crystal ball and say this is exactly the day that that's going to occur. But basic math of the market would tell you the S&P eventually is going to hit 7,000. Now, I'm going to go even a step further, and I'm going to say within the next 5-6 years, you're going to see the S&P at 10,000. And so again, I just tell you this to say we don't know exactly how it's going to happen. We don't know exactly when it's going to happen. But if you follow the basic math of the market, remember, Dr. Siegel did this over 200 years. So argue as you will, but over 200 years of market history, S&P goes up 10% a year. that would tell you S&P's 10,000 points by the end of 2031. And so I know it sounds like a big number. I know it sounds really lofty, but that's just 10% a year when you factor in dividend reinvestment. And that's why I say it doesn't really matter if you're timing the market, if you're trying to trade it, if you're trying to figure out the optimal time, the perfect price to get in. You should just buy equities when you have the money. And if you're doing it on a goals-based plan, it doesn't matter when the S&P gets to 10,000, you will get to 10,000. And you're going to get to probably 12 and 15 and 20,000 after that. It's just a matter of time. So when we went back to the 1980s and our team was projecting out the Dow, for example, is one of the ones that we were following back then. The Dow was hovering between 700 and 1,000 points for years. And we boldly came out with the claim that the Dow would trade at 5,000 points and then 10,000, then 20. And people called us crazy and out of our minds back then and saying we'd never hit those numbers. But we did. And here we are today with the Dow over 40,000 and the S&P over 6,000. And that's why I tell you, over the long run, the market is going to climb this wall of worry. Even the worst run companies are, just to stay in business, are going to have to go up at least about 3% a year. Why? Because that's the rate of inflation. If you can't go up 3% a year, you're out of business. Then if you go on top of that and you say, okay, we're a decently run company, maybe not the best. We're not NVIDIA, we're not Microsoft, we're not, the top of the top of the top, but let's just say you got a mid-tier company and not only are they growing 3% a year, but they're reducing some expenses. Now you're growing 6% a year in equities. Then if they're a really good company and they could do a corporate buyback and a dividend, now you're talking 8% equity return. And that's exactly what a lot of these value companies, these legacy value companies have produced in return is about 8% over 15, 20, 30 years of time. Now, if you go a step further and you look at the biggest and best, and I would call them the elite companies in the S&P 500, the top 10 or the top 15, they are going to go up to the tune of 15 or 20% a year. Why? Because they're growing their profits. Now, those companies are highly volatile, so you probably don't want to put all your money into just 10 stocks. I wouldn't recommend that. But across a broadly diversified portfolio, you're going to have a handful that will go up even faster than the rest of the S&P. And so when you blend the portfolio out and you have some companies at 6 to 8%, you have some companies at 8 to 10%, some companies at 10 to 12, you're going to see those long run averages come in, I think, this is my opinion, at 10% per year. It's not going to be in a straight line. And that's the reality for investors. You're not going to see the S&P go up in a straight line to the right, up forever without any bumps and bruises. You're going to have some corrections. You're going to have some declines. And why does the market decline? So this is the other factor of that PE equation. When we go back to the math of the market, companies impact their earnings. Obviously, companies have some say over what they're going to do long run. Now, companies may not have a say quarter to quarter, and it can just be, sometimes a company just has a bad quarter in a string of 3 or 4 great years. But on the other side of the equation, what really can impact the valuation, that 20 to 21 times forward multiple that I've been talking about, is what's the Federal Reserve doing? Because if the Fed really reduces interest rates, you remember during COVID, that acronym TINA, there is no alternative. It was basically the fact that the Fed had cut rates to zero, a Treasury was paying 0.5% in interest. And so people had literally nowhere to go but equities. Well, now I think some people could still argue, Nick, I can get 4% risk-free on my 30-day money without any volatility at all. I know I can buy a 30-day Treasury and I'm at 4%, maybe even 4.5%, depending on when you bought it. And why should I go risk my money in the equity market if my expected return is 8 to 10%? Well, the answer to that is you're not going to get 4% forever. And when you back out inflation, you're really not getting 4%. You're actually closer to about 1%. And then after taxes, you're probably break even. And if the Fed does cut, and let's say that the 30-day Treasury only pays 3.5%, now you're actually probably losing a little bit of money on a real basis. On an inflation-adjusted basis, your cash is actually going to produce negative returns over time. And so when the Fed is cutting, and we go back to a more normalized interest rate level of where I think we should be, I'm talking from a spread standpoint, let's say it's 3.5% on the federal funds rate. We could be at 3.5% as far as the eye can see without a recession, and that also is going to contribute towards upward momentum for the S&P to hit that 7,000 level. It actually could accelerate it faster depending on what the Fed does. Now, I think we're actually going to post a small little blip on the radar, a recession, just like we did in 2022. And that's what that correction was more so about a few months ago. It wasn't really about tariffs, in my opinion, which I know sounds ridiculous, but it was more so that I think we're going to post a very small recession. Why do I think that? Because again, the market's this discounting mechanism of what's to come. We always get that 22, 25, 30% decline about 6 months before Enberg comes out and calls it a recession. Well, in 2022, we had the same thing. We went down 25%. And remember, it wasn't Donald Trump in office. It wasn't tariffs. It wasn't anything about COVID or anything else. It was just the fact that we had posted a small recession in the summer of 2022. Nobody talked about it, but that's why the market went down and as a reaction to expectations of a declining GDP. Well, same thing today. I think that 20% decline, the worst of it's past us. I think it's behind us. And I don't think you're going to get that 20% again. So that was your major buying opportunity. But again, I still think today you could see the news report later this year. We were in a small recession. We had a recession. But the market could be back to all-time highs. You could be very confused by that and say, well, shouldn't I sell my stocks now? But again, remember, all of this happens looking forward. So by the time it breaks in the news, by the time you read about it on the Wall Street Journal, it's too late. Buying opportunities already passed. And that's where I think we are today. You're going to continue to see a little bit of choppiness, could see a 5% pullback, could see a 10% pullback. That's very normal. It's not a pre-recessionary indicator unless it becomes a 20, 25% pullback in most cases. And you're going to eventually trade the S&P close to that 7,000 point zone. I'm not going to tell you exactly when, but I would guess it's not all that far off looking at the math of the market over time. So stay invested. That's my mid-year outlook. I think good things are coming. We're not going to probably post, maybe we do, but I would guess we're probably not going to post a 20% big time return this year like we did last year and the year before, but that's okay. Just because you don't get a 20% return in the market every year doesn't mean, equities are falling apart. It just means we're in a more normalized environment. And I think you're going to see technology break at just an incredible pace here. Later this year, you're going to see automation and the cloud and machine learning and quantum computing and all these entrepreneurs who are driving innovation forward surprise you to the upside, and that's going to drive profits forward over the long run. Now, I'm just going to give you one idea, and I'm not telling you this as a stock that you should go buy or sell or anything like that, but just one observation that I've had with technology. I think a lot of AI has been kind of nonsense. I think some of ChatGPT is really cool. Some of the generation of images and videos and all that's been really neat. But one of the usable pieces of AI I've just stumbled across now is with Zoom. And so Zoom, the video conferencing software we all got used to during COVID, now has something on their software called AI Companion. And if you click that button called AI Companion, it literally will send you a summary of your meeting with actionable next steps and items that you could complete after the meeting. And for people in our world and people in the legal field and tax and all the rest of it, I think that's an incredible, useful piece of AI. And so, again, we are just scratching the surface. I'm not telling you to go buy Zoom or anything like that. I'm just telling you as an example. I think we are at the cutting edge, just the very tip of the iceberg when it comes to what entrepreneurs are going to do over the next couple of years. So stay bullish, stay optimistic. I'm excited for the future. You should be too. We're not going to do it without a correction. Yes, we are going to have a pullback. But remember, like I started out the show saying, that's your time to buy again. So this is episode 191. I want to just remind you, we've got two big events coming up very soon. If you've been a longtime listener of the show, we've got episode 200 just around the corner here in August. And we're going to throw up the picture on the screen here where you can register. But I want you to come out to the live taping of episode 200 of the show. And we've got a very special episode planned for you. We want to thank a lot of our longtime listeners who have been with us. That's going to be downtown Naperville at Francesca's Restaurant. Very cool venue. And we're going to tape the show live, episode 200 at the end of August. Don't miss this thing. And if you want to register, sign up because it's a very small space. I think we're about halfway full. Katie the Greek, call Katie Poulos at 630-912 8295 is the general line, and then we'll get you over to Katie from there. Or you can email Katie at katie.poulos, Poulos, at stengerfamily.com, stengerfamilyoffice.com, I should say. And same thing, reach out to Katie for Investor Day, October 16th and 17th. That's our big time investment conference, our flagship event we do every year. And we haven't even sent out an email blast. We just sent out the mailers. So you should receive those very soon if you haven't already. And we are at, I believe, over a third full without even sending an email out. You'll get an email from us on that very soon. But by the time you do get that email, it's probably going to be at max capacity. So stay on the lookout for Investor Day. If you want to register today, just call Katie again or email her, katie.poulos, Poulos, at stengerfamilyoffice.com. And we will see you here next episode for 192. Thanks for being on.